guys. Thank you, Bill, for coming back again. I appreciate it. We're going to answer some questions that people have when it comes to infinite banking. And last week when we were talking, you said that you provide some specific examples to kind of help visualize, what it is that you're talking about when it comes to that. And so I appreciate that. I guess, do you want to start with that real quick in regards to like the specific examples as to, how infinite banking works?
Yeah, we can go there if you want. I mean, I have several examples. I'm not going to go through the whole thing. I will just show you how it works. And I'm going to start with a big case, okay? Because everyone then always says, oh, well, this works very well for rich people. And then I'll show you somebody that's just a school teacher. So everything's all, everything is relative. So let me see, did you give me so I can share my screen?
I believe I have shared screen.
Oh yeah, I think you have. Okay, so let me see if I can get it here. Okay, can you see my screen, Stephen?
Yes, sir.
Okay, so let's go. I cut a couple things out. I also took the client's name off. This particular case happened to be a gentleman, came from another agent, and actually he just dumped on me. Hey, this guy wants to get out of pay his house off in 5 years. That was what I got. So I had to kind of figure out what he would need in order to do that. Now, yes, this gentleman has his own business. He makes a substantial amount of money. But it works the same way. As you'll see in the next person I show you, their case is smaller, and they also paid their house off. One thing you'll notice in all of these things when I show people their information, the one thing you'll notice is that usually the mortgage or student debt is always the last thing that goes. And you'll be amazed at how quickly the credit card debt is eliminated, which is really what is stressing out a lot of people. If they didn't have the credit card debt, they'd have more. So what you're looking at is a case, and it tells you right here that he's paying $6,000 a month. Whoops, $6,000 a month to eliminate his debt. Now I know what people are saying. Oh my gosh, oh my goodness, I can't afford $6,000 a month.
Well, is that $6,000 like all debt, including the house? I mean,
no. Well, he's putting in the infinite banking policy $6,000 a month or $72,000 for the year.
Okay.
So a lot of people would go, oh, I don't even make $72,000.
Right.
Well, how people fund it is several ways. This gentleman, he could have done $20,000 a month. The only reason he did it is because we did this last year in the midst of COVID, and he was a little afraid of how his business was going to go. I just spoke to him last week, as a matter of fact, and there was a little situation with his account because the agent didn't handle it correctly, but it's going to be all straightened out this week, and we're going to pay off 5 debts, like right away. And then all he'll have is the house. But what you're looking at is his debts. How we find the money, as I started to say, was either the client tells me, this is what I have extra available. Usually they don't, because they'll say things to me like, this is what I can afford. And this is not what I can afford thing. This is a savings account. If you look at it as a savings account, as a place to park your money to use for opportunities or eliminate debt, it'll make a lot more sense. Instead of it, the infinite banking policies we do are more set up. Life insurance in general is whole life insurance is set up more for banking than for a death benefit. So what you're looking at, he's putting in $6,000 a month. You can see it here. It's redirected funds, $6,000. So wherever he was putting it, he's going to put it in a policy. If you look at his debts, he had, and he didn't even give me the interest rates, but he had, I guess he repaired his air conditioning. He had some kind of resort bill for $20,000. He had a Hard Rock bill for $7,000. He had a car loan for $29,000. He had a filter for $6,000, and he had his residence of $306,000. That's what he cared about. He wanted to pay it off in 5 years, and this is what when I did, this is what he saw. Okay, he right now the way he was paying it, he was going to take 25 years. This is the amount that he owed. If I added up that all his debts, he owed that amount, but he was going to pay $217,000 just in interest. That's money that people give away to a third party that they'll never recover. So in order to pay this off in 25 years, he was going to end up paying $588,000.
Yeah, so like oftentimes when we buy a house, we're kind of like buying two because most of the interest payments are going, towards the bank, right?
Well, we've talked about that in the past. When you get a mortgage, if it's at 5%, 5%, it's at 5%. If you really run the numbers, the only time you pay 5% is in the 29th year. Every other year before that, you're paying a lot more. So as you know, we always say when you buy, when you get a mortgage and you buy a house, you're buying two houses, one that you live in and one for the banker so that he can afford to drive nice cars. So what we did is we weren't successful actually in paying his house off in 60 months. You can see down here, it took us 61 months. But the caveat to this was, the caveat was he only was concerned about his house. We also paid off the AC, the filter, the Hard Rock, the resort, and the auto loan, along with the mortgage in 61 months. So if you don't think he was happy, and he's getting ready to get another policy now specifically to use for his business, because once people understand it, it makes sense. So I'll just go through this quickly because then I'll show you another one. So in 2 months, he should have paid off his AC. He originally owed $3,500. The minimum payment was $100. He was paying more, like most people do, overpaying. So we took that money that he was overpaying and we used it to fund the life insurance policy. So in 2 months, it would have been down to about $3,300. We were going to take a loan, pay it off, and then the $100 that he was sending for the AC, he was going to put in his life insurance policy. And we were going to do the same thing all the way down. What happened was a little situation. So right now he's going to totally fund his policy off for this year. And he's going to end up paying his car, his resort, Hard Rock, the filter, and AC. And in like 2 weeks, he's going to pay it all completely off. And that's going to free up $1,300, $1,296 that he doesn't have to send to a third party anymore. He's going to now put that back into his policy because all these debts, he now owns them. He controls them. It's kind of like when you have a mortgage and you're sending the check to ABC Bank, and then you get a letter saying, Stefan, don't send to ABC Bank anymore, send to XYZ Bank. What happened? They purchased the debt. So that is that one. Let me just show you, because I know what everyone's saying. Well, you got to have a lot of money to do this. So this woman is, this is the whole case. So the same situation, took her last name off. It was she's only putting $500 a month. Where did we find the money? She was overpaying her credit cards and she was putting money into a government sponsored retirement plan. Happened to be a 403B because she's a teacher. I call all that money inefficient dollars. So we take that money that's not helping her, because right now what she's doing, she was going to take her 30 years to pay off her debt. So we took the $500, actually she was paying $529 a month. We took $500 of it and we put it into a life insurance policy, that we're going to be able to use the money more efficiently to eliminate debt. So instead of her taking 30 years to pay everything off, this is her scenario. She only owed $83,000. 48,000 was interest, 132,000 is what she was going to pay, and her minimum payments were 1170. So if I just flip to this next page, you've seen this before. It was going to take her 30 years. This is what she, if I asked her how much she owes, that's what she would tell me. Everyone forgets this. Now, this woman, everyone does it. It doesn't really matter how much money you make. In most instances, she earned $47,000 a year as a school teacher before taxes. This 48,000 is after taxes. So over the next 30 years, she was going to drive back and forth to school 2 of those years for free because she was just paying interest. That's just money being paid to a third-party lender for the interest because they loaned you money. But she was going to end up paying $132,000. So she owed the blue bubble. She was going to pay the red bubble. And with that $500 that she was already spending, instead of 30 years, she paid off her mortgage and everything in 5 years. You could see she had JCPenney, Care Credit, Lending Club, and an auto loan. She was going to pay all of that off in 2 years and 2 months. Same scenario. When she paid off JCPenney, the $50 minimum went in her account. When she paid off Care Credit, the $81 minimum added with 50 is $131. So in 26 months, she almost had an additional $900 she was saving.
So let me understand this, Bill. So I mean, what was like the minimum payments? Is she still making like minimum payments, or does she like how much does she have to set aside and able to get the program started? You know what I'm saying?
Okay. What we did, and this happens with most people. I deal with people that make a lot of money, so they obviously have a lot of extra money, and they can do things differently. This particular woman is the norm. She didn't have any extra money because what people do when they get a credit card, it wasn't JCPenney, it was Care Credit. It was Care Credit. Her debt was $2,480. Her minimum payment was $81. But what she was doing, she was sending $250, $169 more. Why? Well, because Care Credit gives you 0 interest if you could pay it off in a year. What happens is generally, by a wide margin, most people can't. So what they do is they throw all this money extra at it. And then at the end of the year, they add all the interest back in. So all they did was kind of give them their money back. And now they're still back where they started. So what we told her, let's take the 169. We're going to use that money because that's inefficient. She also was putting $180 biweekly was being taken out of her check for 403B, her retirement. And I asked her, she was 38 years old at the time. I asked her, Karen, let me ask you a question. 3 questions I asked her. Can you guarantee me you're going to live to 60 years old so you can use this money? She laughed. Bill, who can do that? Karen, what is this money being invested in? She didn't know. Karen, how much interest are you making, or are you losing money on this? She didn't know. And that's typical of most people because they just signed a plan and somebody else is managing it. They don't look at it. And I told her, you're putting all this money away for like 20 something years. You don't even know if you're going to live that long. Yet you're struggling with this debt. Why don't we eliminate the debt? You're going to have, once everything's paid off, you're going to have $1,170 extra every month. That's $14,000 a year on top of all the interest she saved. So it's not like they have to take money out of their pocket. If we get all their financial information almost all the time, well, here's the answer. I ask you, are you overpaying your credit cards? If they say yes, I can help them. Are you contributing to a retirement plan? They say yes, I can help them. There's other things we can do, but if they answer yes to either or both of those questions, they can get out of debt just like she did. And the biggest Who cares what you have in retirement if you go into retirement with debt? And most people are going in with debt. This woman is going to go into her retirement with absolutely no debt. She can borrow from her life insurance policy, which means her Social Security is going to be tax-free, because when she borrows from her policy, that's tax-free. Plus, she wouldn't have to pay, unless they change the tax laws, she wouldn't have to make any additional payments into her Medicare. So there's a lot more benefits for this lady. She was 38 at the time. We were talking 30 years into the future. You know, that's a long time for people. What her main focus was, how am I going to get out of this debt? She didn't care about the death benefit in the policy because she's 38. She cared about the debt. But 30 years from now or 40 years from now, she's going to have grandchildren, maybe great-grandchildren. Her focus is going to be different. Her debt's going to be gone. Then she's going to care about her death benefit. We're just we're showing them how to use life insurance to their benefit, not to the life insurance salesman.
In this specific example, like with the 403B, if she was taking money, from that, how does this help her down the line when it comes to retirement?
How does it help her? Well, let's take a look. I'll go to I didn't intend on doing this. I'll make it a little bigger. Okay, so this is the ledger. I don't want to go through the whole thing. When I sit and talk to people, I go through this. So when I'm done with somebody, they understand this. But I'm just going to answer your specific question. You could see she was 38 because this is after 1 year. She's 39. So let's go look at her retirement. Okay, she wanted to retire when she was 65. So we stopped this at 64 years old. So if she just followed this plan, all these numbers are guaranteed. Her 403B, your 401k, your IRA is not guaranteed. Money goes up and down. In her policy, her cash value, this column is cash value, it's $226,000. Her death benefit, which started out at $200,000, she didn't care about, is now $555,000. But she's not going to have, if she follows the plan, she's not going to have $226,000. She's going to have $551,000. She's going to have $336,000 more. Where did this money come from in the gray column? This is all the money she would have given to the banks, the automobile, the credit cards that she was giving to them over the next 26 years that now she's giving back to herself. So here's the way when I point out to her, I go, look, you're going to have $551,000. If you could only earn 4% interest on this, that's over $22,000 a year you're earning in interest, which tells me you could take out $20,000 a year, never run out of money. And since you're borrowing it, she could be 115. She'll still have $551,000 available to her. That's like her credit line. So she's going to borrow $20,000 a year tax-free. She's also going to get her Social Security tax-free because this is not taxable. She's also not going to have to pay any money into her Medicare because everything we're doing is tax-free. But I say this to everybody, and I said this to Karen. Karen, if you tell me you'd rather have a 401k, an IRA, a 403b, and you had the same $551,000, if you want to take out the same $20,000, you're going to have to, you can't borrow it. You're going to have to take it out.
Yeah.
So you're going to have to take out about $25,000, $26,000, $27,000 to pay the taxes. So what's going to happen are two things. One, you got to pay taxes, which is going to make your Social Security taxable, which is going to mean you're going to have to pay into your Medicare. But the worst part of it is, if she lives to be 115, she's going to run out of money. The way I show them, she'll never run out of money. And the problem, unfortunately, the problem is 85 to 90% of the life insurance salesmen sell people death benefits. you have a greater need for cash in your lifetime than you will ever have for a death benefit. It's just the way it is. So we're using life insurance the way it was really meant to be. The reason people don't know about this is because the life insurance salesmen are trained by the life insurance companies. And the life insurance companies want to sell you the two most profitable products. What are they? Term. You heard this. Buy term and invest the rest. Bull wonkies. Or IUL, universal life product. I always tell everyone this when I talk to other life insurance guys. There's only 3 reasons why you would ever sell somebody a universal life product. 1, they told you they're going to die early because the policies collapse when they get older. And I hear the life insurance guys tell me, but I call that but. Oh, but we can do this. There are no buts. All you have to do is follow the plan. So they either die early, the life insurance agent, which is usually the case, doesn't really know what he's selling. They're less than knowledgeable. Or 3, unfortunately, they're less than honest. I always say you're crooks. Why? Because the commission on an IUL is huge. The commission on what I do is about 40% of what that is. Why? Because most of the money is going in as cash. They need to use that money for either opportunities or to eliminate debt, whatever. So that's the story. I didn't intend on going here. It just so happened we were on this one. So does that answer your question?
That answers my question. I hope it's not too in depth for other people, but
well, if they call me, I understand. Here's what happens. When people look at this page, they see a bunch of numbers. And this is, I always say to them, I go, look, I know what you're looking at. You're looking at a bunch of numbers, and this is when financial advisors and life insurance salesmen get to baffle you with BS because you don't know what you're looking at. The way I do it, I go back to elementary school when I explain this to them. When I'm done, you understand everything on this page. You might not remember it 2 days from now, but when I'm done, you have enough knowledge to make a decision. And I tell them, I go, look, what's happening here is in the 7th year. This is why people don't buy life insurance. In the 7th year, this person has put in $6,000 a year, every year for 7 years. Their death benefit has gone from $200,000 to almost $300,000. So when they put $6,000 in every year, $3,740 goes in the banking portion. Okay. And the next year, they're going to put in $6,000 a year. $3,740 goes in the banking portion. But I always ask them this. Well, how come this number then doesn't say $7,480? Because that's double. The reason it doesn't is your money's working for you. While she's paying off debt, she's still earning interest and dividends because you're not taking your money out. So here's what I say to people, and they all give me the same answer. I said, look, you just paid $2,000, which the difference between $6,000 and $3,740 is $2,260. If you multiply that by 7, it's $15,280. So I ask her, you just paid $15,280 for a $293,000 death benefit. Other than the fact she has 2 children, other than the fact your children are going to get this tax-free, I'll ask anybody this question. What is the benefit to you personally right now? Everyone tells me there is no benefit because the only way they're going to get this money is you have to die. I have not met the person that has told me, do you want to die at 45 years old so your kids can get this money? Everyone says no. This is why people don't want to buy life insurance, because she feels like she just threw away $15,800. It's $820. That's what she felt like she threw away. But what's in it for her? All her debts are paid off. She's saving an additional $14,000 a year. She saved $34,000 in interest, and she's got $39,000 in cash, all at a cost of $15,820. So I ask them, you got $39,000 in cash, you save $33,000 in interest, you paid off all your debt, you've got an extra $14,000 a year at a cost of $15,820 plus a death benefit that you don't care about. Is this a good deal? Everybody says yes. It's just the way it is.
No, you're the man.
Well, no, this stuff I know because this is what I do, and I'm a numbers guy. Yep. The hard thing is, can I shut this or you have any more questions?
No, you can shut it. That's fine.
Okay. So the hard thing about this is people have to make a paradigm shift in their head because yeah, exactly. I tell them, open up your head, take the brain out, put it here, and put the new brain in. Because I'm going to tell them what they need to do is 180 degrees from what they're doing right now. Once they get it, I can't teach them this. This is not something that can be taught. As Nelson Nash always said, it needs to be caught. Sometimes it's caught in a week. Sometimes it's caught like a client I just had in 5 years. She's paid off out of 17 debts. She's paid off everything, all gone except her second mortgage gone. All she has is an automobile and a first mortgage. It's going to be done in a year. Boom, she's done. It took her 5 years to realize. She said, I don't know how it happened. I just followed the plan. That's all she did, religiously. It's guaranteed to work. I'm not like the other guys. It's not, it's not like a stock market that goes up and down or whatever. And then, oh, Stefan, I didn't know that there was going to be Corona. I mean, look, financial advisors give great advice. They work hard. The problem is they can't predict the future. So they don't know when coronavirus is going to hit, and they don't know when guys are going to fly planes into buildings. And the advice they gave people on September 10th, 2001 might have been the great advice. But on September 18th, a week later, they still lost half their money. Is that the fault of the financial advisor? Not really. It's the fault of life. Life happens. People, we don't know what's going to happen. But if they had a whole life insurance policy and they had cash value in it, their money doesn't, every day it marches on. It gets higher and higher every day. Yeah, it's kind of like the tortoise and the hare, but who ended up winning the race in the long run?
There you go.
So,
Bill, I thank you so much for your time and answering this one question here. This is where I love getting into stuff because the numbers are like, that's the proof of the pudding. That's where it's at, And for me, numbers don't lie. So I very much appreciate that. And I'm sure other people will as well. We're going to do this every Tuesday, guys. We're going to meet up. We're going to, ask Bill some questions and, let him go through it. And I'll invite Karen as well. And, when she's able to come on and we'll just go through it. But I very much appreciate it, Bill. Thank you very much.
All right.
We'll do this again next week.
You got it. You have a good day. God bless you.